Hey everybody, Russell Gray, co-host of the Real Estate Guys radio show, here with another edition of Boots on the Ground. This one is July 2020, and we're talking to our good friend in alternative commercial lending, Billy Brown. How you doing, Billy?
Russ, doing fantastic. We made it through July 4th holiday, made it through most of the COVID stuff. So I'm smiling right now. So it's a good sign.
All right, smiles are good, right? The economy hasn't collapsed. The financial markets haven't collapsed. People aren't necessarily all completely homeless and hopeless. Definitely some things to be concerned about. And one of the reasons I like to keep visiting with you are twofold. One is, obviously, I am wanting to kind of know what the tea leaves hold. What do you see in terms of the trends? Are lenders getting looser, lenders getting tighter? You know, in 2008, there were a lot of tremors in the credit markets that were presaging a lot of the difficulties that came later. Now, after my 2008 experience, I've learned how important it is to pay attention to people like you that have your thumb on the pulse of different aspects of lending. So that, I think, is going to be a big part of the conversation. And of course, you know, for real estate investors out there, mortgages and debt and are a major tool. And we want to know, what is the condition of the tool? What is the availability of the tool? What is the price of the tool? What are the new tools or innovations? Where are the opportunities? Where are they not? And of course, you know, you deal with a lot of different investors, and they are using different strategies, and they're active in different ways of making money. And so you see that. And so, you know, if you have any pearls of wisdom in that regard, but we want to keep it short. So why don't you give us kind of the nickel tour on, you know, where lending is at? Are things tightening up? Are lenders feeling more optimistic, or do you feel like they're still kind of battening down the hatches?
Yeah, so we'll break it down very simple for you. You got the owner occupied. This is both, you know, the house you live in as well as the office that you may own yourself. That is actually more aggressive. Feds came in and bailed out, obviously, the mortgages and all that. So rates are very, very low. If you have refinanced your house, you can buy something. Today is a great day to go do it. They're still doing HELOCs on your primary residences, which these banks, a lot of money available right there at cheap rates. Now, when you flip it over into the investment side of the world, where you don't live in the property or you're trying to go buy something different, that's a whole other capital structure there. And you got both bank and non-bank. So kind of break it down for you in that terms of where the money's coming from. The bank world, if you haven't heard this thing called PPP, basically the Fed said, hey, go lend out all your deposits and we'll get your money back to you in about 8 weeks or so. Well, the banks did that, and the Fed has not paid them back. So the depository lenders are very light on deposits, and of course that's how they make money. So they don't have much to lend. So that's why they're focusing on the owner occupied stuff. The stuff that comes with deposits. The non-bank guys that are more the hedge funny types, they got shellacked and have been shellacked with margin calls and all the how they hyper leverage all their money, which you.
Oh, okay. Hold on. You know, we delved into the realm of jargon, which is great. I just want to interpret, because I don't want people to just like, whoop, I don't know what the heck he's talking about. So, okay. So hedge funds, private money, these are non-agency, non-banking. They're not depository institutions. They're like giant syndicators. They basically raise a bunch of money. They have private money, and they decided they want to be on the debt side of the world. And so they make loans. Okay. So that's fine. And mortgage brokers, I was a mortgage broker, lend on their behalf, originate the loans. They don't want to deal with the end borrower. They just want the income stream. That's really their income investors. But they also tend to speculate on the bond pricing. And this is what a lot of people don't understand. And this is probably the most important thing I didn't understand, the most important thing that I learned coming out of 2008, but arguably the most important thing that people who are trying to understand the pressures on interest rates and the direction and what's going on in the real credit markets, the bond market, is going on. And it's very simply this. Bond prices are inversely related to bond yields, just like apartment buildings. So when cap rates are low, that means prices are high. Investors are paying a lot more for the same income. Same is true in bonds. So think about that. Instead of cap rates, it's yields. And for whatever that rate is, when rates are low, it means investors are paying more, bidding up the principal value of the bond. They're overbidding. Say it's $1,000 bond. I'm just going to make up numbers. It's $1,000 bond or $100,000 bond or whatever it is. And then if the coupon rate, the rate it was issued at, is a certain rate, and the rates go down below that, then that means the bond is more valuable in principal. So somebody who's a bond trader is going to buy and sell those bonds the way you flip houses. They're going to buy a bond and hope interest rates go down. And then when interest rates go down, they sell the bond and at a markup, and they get to keep the difference, of profit. Does that make sense?
Oh yeah.
Okay, you with me so far?
I'm
Okay.
with you. Yeah. So
Well, I didn't want to monologue, but I just want to make sure people get it. And if I misspeak, feel free to interrupt me. But, I mean, I know you're in the business, and I think I have my mind around it. So these guys, you mentioned margin calls, and this is the other side of the equation. So these guys take these assets on their balance sheet, and rather than sell them, they don't want to let them go because they think interest rates are going to keep falling. So they borrow against them, pledge them as collateral, the same way you would borrow against your house and take equity out. They borrow against the bonds and take equity out, if you will. And then they go try to maybe buy more bonds and double down or triple down or quadruple down because they're convinced interest rates are going to drop. But if interest rates blip up, then it all goes the other way. The difference between a real estate investor and a bond investor is the bond investor gets that lovely thing called a margin call. When the price goes down, they either have to sell at a loss or they have to bring cash. So when you say they got shellacked with margin calls, they were on the wrong end of the trade. They were betting the market was going to go one direction and went the other direction. And so now that affects their investing willingness, their psychology. So pick up where you left off.
No, that's the professor there is just explained it in a very succinct way. So that's a great way to explain it. But yeah, they got shellacked. So there's a lot of speculative money out there that came in and bought stuff for 60, 70% cents on the dime on these warehouse lines, and are making a killing now, hundreds of billions of dollars.
Warehouse lines is like a home equity line of credit for a mortgage broker. So they're going to go out there and they get this big line of credit, and then they make loans. So they convert. It'd be like if you were flipping homes on your credit line. Let's say you had a $10 million home equity line of credit because you live in this mega mansion and somebody would be willing to give you a loan that big. And you go out and you buy a bunch of $100,000 houses with the idea that you're going to buy them and flip them, and you're going to make, a few points. You might make $10,000 a house or $5,000 a house or whatever, and you're going to do volume. So that's what these guys are doing, but they're not flipping properties, they're flipping debt. So they borrow, then they lend, and then they sell the loan, and then they pay back the warehouse line of credit. And of course, you can imagine what happens in flipping houses if you get caught in a downdraft where you can't sell because there's no buyers, or you have to sell at a loss. Now all of a sudden you've got this warehouse line of credit that's not a tool, but a millstone around your neck.
Yeah. And that's it. We kind of went down the weeds here, but I wanted people to kind of understand like what happened, because that mechanism, the music stopped. So there's no buyers for this. So
and when did this happen?
Last time we talked, it was really the depths of it. So March, April.
Okay, so they're still feeling it, and they're so the people who went through the Great Depression and people like me who went through the Great Financial recession. It changes your investment philosophy. It changes your risk tolerance. It changes your investment strategy. And so, Billy, what I hear you saying is that these people have had a little bit of trauma, and now it's affected their willingness to lend.
They're dipping their toes back in the water. They're kind of seeing what's going on. It's very positive in many asset classes, and some not so good. Single families, they're starting to become more aggressive with, actually.
Okay, so they like single family.
Family rentals.
What else do they like?
Portfolios, apartments, obviously anything.
Apartments, that makes sense. Okay.
Yeah, so
what else?
Those are doing pretty good. You can imagine they're not going to be too long on hospitality.
Number one source of job losses.
Office, not going to happen there. But some other stuff that they're really taking a shine to is, the light industrial warehouse. Obviously, in a order from your phone type world that
So
we live
light
in.
industrial, like houses that have bunches of racks of products that are being distributed.
Well, like just like warehouses where you have like a little small front office there, and you've got a bunch of office, the Amazon worlds where you're going to be close to the corridors, and people are going to make something, house it, and then ship it out to you where it may
Gotcha.
be.
Okay. Gotcha.
Yep.
Gotcha. Light manufacturing.
The
Gotcha.
manufacturing. Yeah. So
Okay.
they really like that. And then self-storage is kind of neutral. They kind of, self-storage stands basically everything, when things are great, people have more stuff. When things are bad, you got to have plus stuff to put your stuff.
Yeah.
So it's that's going pretty good. But as you can imagine, the cost of capital, I'm kind of getting the point here where everyone wants to know is like, what's going on, Billy? What are the rates? Like, well, here's where it comes in is your cost of capital. It's opportunity cost because the Fed didn't come in and bail out some of these industries and put a bottom on the price. So you've got opportunity costs. If you're sitting on
So the
billions of
street
dollars,
interest rate goes up a little bit because they want a little bit more reward. Because really, I mean, just again, taking it back to the basics for people that don't understand, we think of interest rates when we're receiving them as profit on money lent out, and we think of interest rates, when we're paying it, as just an expense, a cost of borrowing the money. But really, what interest rates are in an economy are a risk premium. They're like they're like the insurance premium. They're what you get paid for taking the risk, and so the relationship is the bigger the risk, the more reward you want, right? That's why things that are considered to be very low risk or low interest pay low interest or cost low interest, and things that are considered high risk have a higher interest. And so now what you're saying is that they feel that they're in greater danger. And so at the street level, interest rates are rising, even though in the real world, Fed is trying to push them down, but that's not translating, policy is not translating into actual functionality on the street.
no, not at all. It's true market pricing because they have opportunity costs baked into that. So they're going to go after the safe stuff. So they've lowered their leverage. They're actually, mostly, generally speaking, they're higher leverage, sometimes 80, 85% of cost. Now they're down to 65, 70%, if at all, in some asset classes.
So they
And you
want
get the
bigger
higher
down
interest.
payments,
Yep. So more down payments, so you get more capital. So you can
more cash
invest,
reserves, I'm sure.
more cash reserves.
What about ratios?
As far as your
Debt coverage?
yeah, those go up too. So
Yeah.
obviously,
Okay.
if your
I would
LTVs
expect
go
that.
down, yeah. Some of the minimums now went from 125 to 135, 14, 15, depending on what asset class that you're in.
Okay.
And
Again, just real quick, no investor left
yeah,
behind. So debt service coverage ratio, either DCR, debt coverage ratio, or DSCR, debt service coverage ratio. They look at the net operating income on an income producing property. So the gross revenue less the operating expenses is the net operating income. So NOI doesn't have anything to do with debt. So that's the amount of income that's available to debt service. They want to see that income be 100%, obviously, of the loan payment plus a safety factor. And when they're feeling bullish and they like it and everything's good, that thing can be as low as maybe 10%, 15%. Probably floats normally, what, Billy, around 20, 25?
20%. Yeah.
Okay. And so that means that, let's just say you have a loan payment coming in of $10,000 a month. They're going to want to see about $12,000 a month of net operating income when they underwrite that. Today, you're saying they want to see more like 14 or 15,000. Is that right?
Yes.
Okay.
Plus reserves, plus, they're,
And probably stronger balance sheets too, right?
Stronger balance sheets with the borrowers. And again, this goes back to my prognostication back early this year is, we were out on the fringes as far as, not the fringes, but we're getting close to fringes of what fundamentally is a real estate investment and safe to go lend on. Now where it's snapped back and now you got to be down the middle, both on the asset class itself as well as the borrower. So newbies are going to have a tougher time finding debt that's cheap. So you're going to have to either bring on somebody that has experience, which I definitely recommend. There's a cost there, an investment, so to speak, not say a cost, for bringing that person on as part of your deal, because you can get a better return as well as, better.
Yeah. I mean, this is just, again, so, if you're watching this and you're a solo investor, you're thinking about investing, or you're
Yeah.
investing in your own account. What we're talking about is that when the rules change or your circumstances change and you don't have enough of something, whatever that is, I don't have enough down payment, I don't have good enough credit, I don't have enough income, I don't have enough cash, whatever it is, I don't have enough expertise, I don't have a credible enough resume, I don't have enough experience, whatever you're missing, you can go get an investment partner. If the deal makes sense, whatever you're missing, you can go get. That's called syndication. That's why we teach the secrets of successful syndication. Billy teaches there, obviously I teach there. So if you're interested in learning how to do that, check out the syndication course. Just go to, send an email to syndication@realestateguysradio.com. We have both an online version and a real in the room version when they let us come out of our sheltering in place and actually gather together again. But that doesn't have to stop you from learning. So don't be dismayed if you feel like, oh my gosh, I don't qualify to be able to do this. You really just have to know what you need to go get, and that's the training. And then once you have that, you develop the skills to do it. And people like Billy can help with the financing side, but there's lawyers and all the people that you need to do all the parts that you need to do. And then you put the deal together. The one thing that we know is that when the economy goes through stress like it is right now, there's typically going to be good quality assets in good markets that are going to be available for a good price, a fair price, or actually just a flat out steal, because people are desperately trying to patch the problems that are created with the stuff that wasn't so good. So there's a lot of repositioning going on right now. So if you're on the wrong end of that, it's uncomfortable. But if you're on the outside looking in, or you have a chance you're on the right end of it, it means it's a great opportunity to accumulate assets. But the rules in the environment are changing. That's why we're doing these boots on the ground updates, because it's changing fast. You can't just talk about this and go, okay, well, let's visit again in 6 months and see what's going on. It's like, man, pretty much every month we need to get an update. So what else
Yeah.
is happening?
Yeah, so it's about every 2 weeks things are changing. Usually at the end of the month, you'll see some coupon flips over, and you'll start seeing some loosening, hopefully, of lending. But for people going into this thing, you need to expect that 65% of after repair value is your new normal. 75% of as is, as long as the debt service coverage ratio is there, you're going to be pretty good shape and kind of get anything you want to there. The bridge lending world is coming back online. That's the one that got to kind of hit the most, but that snap back very, very quickly, because you're going to start seeing a lot of opportunities, especially under $2 million on the multifamily, from these mom and pop investors that weren't ready for COVID, or they were amateur managers. There's opportunity there. So we've got, bridge lending is available for you. That's again back to the 70% of cost, and usually 70 to 100% of rehab, depending on where we're at in the deal.
So actually, I think that's probably a little bit of a bullish sign, because again,
Yeah.
just so you understand, a bridge loan is kind of like a temporary loan. It's to bridge you between, maybe starting a project that you're not ready to get permanent financing on because it's not finished, it's not producing income, whatever. So, it could be a rehab or a new build or whatever it is, however it works. So you get this temporary loan, and then your whole ability to be able to pay that loan back at the end of this short term is that the other end of the bridge actually lets you off somewhere where there's,
Yeah.
and so
It's not a cliff.
yeah. So the danger for the bridge lender is that you don't have an exit strategy that's viable. And so, when they look at you, they look at the project, but they also look down the road a little bit and ask themselves, hey, when this person goes to have a finished product, are they going to be able to restructure the financing? Will the funding be there? Will the buyers be there? Will the income be there? Because otherwise this bridge loan is going to end up either turning into a workout or a partnership or something, because they're not going to be able to get paid back. So the fact that bridge lending is kind of still there, and maybe even sticking their toe back in the water, I think that's a little bit of a bullish sign, wouldn't you say?
I'm very surprised. I'm very happy and surprised at that. I do see with all the market trends, again, it could change next month, But, you know, the
Or this
trend
afternoon.
is, or this afternoon, I mean, it happened that fast in our secret syndication, my debacle there, but that's a whole other story. But yeah, it can happen very, very quickly where it's gone. But right now, they're starting to see that there is a niche there, the product need of, well, you go back to the agency data, just to speaking multifamily, where they're not even looking at anything less than $2 million. They say they will do small balance to 750, but they're not even looking at less than $2 million. There's so much inventory out there that's really, really good. And some great, great syndicators and sponsors that they want to focus on those guys and not the newbies. Well, that opens up the opportunity for some of the depository lenders and other lenders to step in. And of course, we know that the agency debt guys aren't going to look at anything less than 90% occupied, and they got to have collections. Well, guess what happened in COVID? Well, we still got workouts with people trying to get evicted, which may not get evicted until 2021. So now you get these bridge lenders come in that understand that if you get the right price, you can step in there and get some really good deals, assuming you have the risk tolerance to go make this thing right. So
Yeah.
there's always opportunity there. So don't think that just because one lending is tighter that something else is going to come up. There's always opportunity. Of course, the best lending source, which between you and me, Russ, don't tell anybody else, the sellers. You know, don't tell anybody else, but the sellers are actually.
Oh yeah, sure. Absolutely. Right. Because if there's no
between
other
you and me.
buyers, if you're willing to come, you know, if you put the numbers together, right, I mean, their equity is actually available. So
Yeah.
owner carryback, I mean, that's one of the holy grails of creative financing, going all the way back to the high interest rate dates. You know, last time we had a dollar crisis in the 70s, we ended up with interest rates that were so prohibitively expensive. The only way anybody could get a deal done was to be creative. And so I do think, Billy, there's going to be a lot of creativity. That's why I love that you're in the alternative funding space, because you're not stuck with just agency guidelines. I mean, you're certainly aware of them and they affect what you do, but there's a whole lot more creativity on your side of the field. The reason I'm interested in talking with you is because I feel like I can get a little bit of insight into what really smart people who are paying attention to market dynamics are thinking. Obviously, people, it seems to me, just based on what you're saying, is that lenders are feeling like we're definitely not out of the woods yet. Part of that is they're just in a cash flow crunch with the Fed. I don't think anybody thinks the Fed isn't going to come up with the money. They can print all they want. So I don't think that's the concern. So that is actually, I think, kind of good. But they are focusing on what they consider to be more quality, less risky assets, and that's residential, both homes and apartments, which makes a lot of sense because those tend to be favored by governments, by banks, you know, the Fed, and by voters. You know, so I think that typically is a safe haven real estate sector to go into. The light industrial, that's pretty interesting to me. And I think you mentioned off mic something about a difference between owner occupied and non-owner occupied, but we didn't mention that. Do you want to talk about that for just a sec?
Yeah. So just kind of give people some insights here that may have their own business that own their own real estate. Now is a really good time to reach out to your lender and say, hey, now it's time to restructure this thing, because it's prime is really low right now, and it's prime plus a little bit. And if you can bring some deposits to the table, they will eat out of your hands.
So in other words, you're saying that they're offering sales discounts. They're trying to attract a certain type of borrower. They're putting bait in the water. It's like, hey, if you are a small business owner and you are owning the building that you're operating in, you're like an owner occupied person. You care about that building. You've got skin in the game. We're willing to make that loan, as opposed to other loans where, you know, the people aren't living in the property, or it's not housing somebody. The business could just shutter, go offshore, or close the doors completely, and nobody cares. There's no personal balance sheet, no personal pride, no personal guarantee, nothing. You're just, and that makes sense to me, right? So that tells me that they're still very skittish about small business going forward, and they're looking for the safest place to play, and they're looking at owner occupied.
Yeah, you just think about what you said there as far as you have skin in the game. Well, you have a business there, assuming it's doing okay in COVID. They're going to check that out, obviously. They want you. They want your relationship. They want that treasury management, everything else you can sell you in the bank world. and they're going to trade that off because their money is their cost of capital is very, very cheap right now. And they want to attract that, and especially from somebody else.
Yeah.
Especially on their bank there. So you can leverage that up. If you do have equity in properties, now's the time to reposition that, so long as it's safe for you. So just to put some strategy out there for folks. But the non-owner occupied, the risky stuff. Because think about this, you may not have enough reserves. Well, let's stop this. So my philosophy, and I always say this as an investor, as a lender, is you're buying someone else's headache. Your goal is to find out how much of a headache that thing's going to be for you, and if you can mitigate that. Well, same thing on the loan is you're lending on someone else's headache, and that other lender's headache. Well, how much of a headache is that, and how much of a risk is that for you, and do you actually want that? Well, especially right now, we're still in the middle of this war, especially the
COVID-19 war, the war on
germs.
Yeah, the war on germs.
The war
not
on
Germans, not Germans, just germs.
Germs. You don't know if you're winning or losing. So it's easy to say, oh yeah, it's a great deal right now. But you look at like, hey, we got 90% occupied, but how many actually are collecting the rent?
Yeah.
Are they actually paying? And then if they're not paying, well, how long is it going to take me to go evict these?
Yeah. Cause we get this unemployment at the end of the unemployment, extra bonus benefit thing winding down too. So there's still a lot of uncertainty out there. Yeah. Okay. So what about cash out? Let's close on that because we're at the end of time, but what about how readily available, how easy is it for people to be able to get equity out of properties while it's still there?
Owner occupied, fairly easy. Non-owner occupied, just real estate, you're going to be low leverage. Low leverage. You got to go through the Fannie.
So you'd have to have gobs of equity. The person that has properties that are paid for or 30, 40%, loan.
And they're still lending out there, especially the non-depositories. Depository guys, like I said, they don't have any money. They don't have any deposits.
Yeah, that's temporary though.
Yeah, it's temporary. So that's going to be a little bit, but the hedge funds that are coming back on, all the money that's out there as far as the Wall Street money, there is availability. And I've got some that are still lending and getting aggressive. Kind of a little case study. We got a guy that actually has very low leverage, actually no leverage on a bulk of properties. He's got a contract on like 18 units. And we're going to come in, and my lender's going to be able to come in and basically do a refinance, reposition that equity, and it's the down payment on the new one, all at 70% across the board. Give the guy a $350,000 cash back at closing on a non-recourse loan, and then whatever options he wants, either interest only.
Yeah, that sounds like the good old days. Well, good. I'm glad some of that's still happening out there. Okay, Billy. So I'll give you the last word. Anything you want to say to folks in closing?
Down the middle. You got to be down the middle. You got to be down the middle. You got to be down the middle. Don't expect anything in the near future to be outside of the edges. It's all in the buy. You got to buy right, and you cannot trust the numbers of the sellers. You got to do your own due diligence. Underwrite more vacancy and underwrite a rent decrease in 2021, not an increase.
Okay. So. All right. Well, there you go. Billy Brown. So your contact information is down below in the show notes. So really appreciate the time. We'll catch up with you for next month for our Boots on the Ground update. Thanks, Billy.
Thanks, Russ. Appreciate it.
All right.